The housing market is booming. Home sales are at record highs, and prices are at levels that haven't been seen since before the recession. But is this boom sustainable? And what happens if another bubble pops? The Federal Reserve recently announced that it plans to raise interest rates twice in 2019, a move that could undermine some of the gains we've seen in recent years. With so much uncertainty about where things stand right now, it's important for us to understand how we got here in the first place and think about what might happen next. The housing market has become a haven for speculators. Is the housing market a bubble? The answer is yes. It's not just a bubble, either. It's clearly one of the biggest and most dangerous bubbles we've seen in recent times. The trouble with bubbles is that they're really hard to spot until they burst. And when they do, they have devastating consequences. The most recent financial crisis was caused by two very big bubbles bursting. First in housing prices, then in subprime mortgages. Now that our economy has recovered from those collapses, we're back to building new bubbles like crazy. And this time around, there are plenty of reasons for concern about what might happen next. Is the housing market boom dangerous? Yes. The answer is yes. In fact, the housing market boom isn't just dangerous for homeowners. It's dangerous for everyone. Home prices are rising too quickly, and homeowners are overextending themselves with loans they can barely afford. There's no guarantee that the government would intervene if another crash happened tomorrow, nor is there any reason to believe that mortgage industry practices will be any less sloppy going forward than they were during our last financial crisis. A bubble is coming, and it could be much worse this time around. The government is not going to bail us out again. If you're thinking that the government is going to bail out the housing market again, think again. After the subprime mortgage crisis, which was caused by irresponsible lending practices that led to millions of foreclosures, banks were afraid to lend money to anyone for fear of getting stuck with bad loans again. The lack of access to credit meant that many people couldn't buy homes and others could not refinance their mortgages when rates went up. This put pressure on prices because demand was low and supply was high. Because so many properties were unoccupied, more than 2 million homes were in foreclosure at one point. The government stepped in and said that if banks repurchased some mortgages from homeowners at a discount rate, then those homeowners would get new loans with lower interest rates than what they had been paying before. This program helped stabilize the housing market by improving access to credit, while also reducing inventory since fewer houses were going into foreclosure or being abandoned. The industry is not prepared for another crash, and there are several reasons for this. Lack of regulations. The government has done little to regulate the housing market. As a result, it's nearly impossible to know who is actually buying homes in the U.S., how much money they have invested in them, or what their qualifications are. Lack of government oversight. Our federal government has also failed to monitor potential risks in the mortgage lending industry adequately over recent years, despite warnings from economists about potential problems down the line. Lack of industry self-regulation. While some banks and lenders have increased their scrutiny over loan applications since 2008's economic collapse, many others have not taken any steps towards improving standards within their own organizations. Instead, they relied on lax federal rules as well as computer systems that are incapable of identifying risk factors as red flags when processing applications, such as low credit scores. Housing boom or bubble? A housing bubble refers to a period of rapid and unsustainable growth in home prices. A housing boom, on the other hand, represents increased demand for homes due to favorable economic conditions and an increasing population. As with all booms, there is a risk that the increase in demand will outpace supply and create an imbalance between supply and demand that leads to price increases. While both types of conditions can result from strong economic growth, they have different effects on economic stability. While bubbles can be harmful because they lead people into making bad decisions about their finances, as investors overvalue stocks or houses, booms are good because they encourage people to buy homes instead of renting them, which helps build up wealth over time by providing owners with equity gains as well as appreciation in property values. That said, there are some warning signs you should watch out for if you think your city might be experiencing a dangerous type of housing boom instead. If your neighborhood has seen large increases in home values but doesn't have amenities like parks nearby or public transit access. If new housing developments seem designed primarily for higher-income households, we're in uncharted territory, and the housing market's future looks unclear. The increasing number of homeowners, coupled with little inventory and high demand, have created a competitive market that is hard to navigate for even the most seasoned real estate agent. If you are planning on purchasing a home or looking at refinance options, it makes sense to know what's happening right now in the market and get an idea of what might happen next. Conclusion: overall, the housing market is in an unprecedented position. It's difficult to tell whether we're experiencing a bubble or a crash, but it's clear that we need to be cautious with our investments and prepare for either outcome.